I have traded the ICT Turtle Soup model for years on end, and I keep getting questions, can you please make a simplified video of your strategy? Now, the Turtle Soup strategy is not the only one that I use, but it seems to be the one that you guys are the most interested in. So in this video, I'm going to break down exactly how I look for it and how you can look for it, and it does not need to be very complicated. So in other words, this video is going to be a simplified version of the ICT Turtle Soup, and let's get right into it. So if we take a look at my screen right now, you can see that I have drawn out sell side liquidity and buy side liquidity. What's important to understand here, or what I mean by this when I draw it out, is you must have an objective in mind before any strategy is going to work. You must have a point in price where you think the market will go next, aka your drawn liquidity. Now, a lot of people want to overcomplicate this and think it's very, very hard to establish a proper drawn liquidity, but that's simply not the case, okay? With ICT concepts, there's so much information out there, and that is why people are getting confused, but you can use external and internal liquidity as a way to get a really, really simple and easy drawn liquidity. So in this example, let's just say that this up here is external buy side liquidity. And when I say external buy side liquidity, I mean the highest point of a certain trading range. Okay. Now, what we can see right now is that sell side liquidity is still open. Okay. The stop losses or liquidity that is resting below the sell side, let's say that this is external sell side liquidity, which again is just the lowest point of the trading range, that has not been accumulated yet. So what we see right now is that price was trending to the upside very, very normally, making higher highs and higher lows, and then it took out external highs, right? So the buy side liquidity that we had established is now taken. Now, an easy way to get a daily external high and external low is to simply mark out the daily high and the daily low from the daily time frame perspective. So the daily candle, you mark out the high and you mark out the low. The highest point of that is your external high. The lowest point of that is your external low. There's a bunch of ways that you can do this, but that is the simplest way. So let's just say that this is the daily candle high. We saw a sweep of the high and we had no follow through to the upside. Now, when I say we didn't have any follow through to the upside, that is very important, okay? Because that is going to tell you a lot about the order flow. So if we sweep a significant point of liquidity, which we have established that this high is, and we get absolutely no follow through to the upside, well, then that tells me that the market is probably bearish after sweeping that high. And again, we want to pay attention to whether we get follow through to the downside. So how do we establish follow through? Well, we take a look at the high after we swept the high. Did that displace above the high? Did that displace above the external buy side? Not really, right? We peaked above, created a high, and then we displaced to the downside. Now, a way that we can establish displacement is to look at opposing PD arrays. So for example, if we had bullish imbalances right here, you can see that we have no trouble violating all the bullish imbalances that we have after we swept the high. And so that will tell me that the only reason why price traveled all the way up until this high was to sweep the liquidity that was resting above the high. Because again, I got zero follow through, and if the market really wanted to go higher, I would expect it to break above the high, retest that high, and then continue to go higher. So when I simply get a peak above the high and then an immediate displacement lower, that will tell me that that indeed was a liquidity sweep. Now, what I am looking for after my external buy side or sell side liquidity target has been hit is what we call a market maker sell model or a market maker buy model. So essentially what that is you have a drawn liquidity, which in this case is going to be this sell side liquidity, again, because we have swept our buy side objective. We got no follow through to the upside, but we are getting follow through to the downside. So I'm going to expect my sell side objective to get hit after my buy side objective was hit. So what I'm going to look for now is consolidations, okay? So the first consolidation that we see is the one that we have right here. What ICT traders will call these consolidations is first stage distribution, second stage distribution, and then maybe a third stage, but usually you'll only get two stages. Again, that's why people get confused, because they have fancy words for consolidations like first stage distribution and second stage distribution, when in reality it's just two consolidations. So after your high has been swept, you wait for the displacement, then you wait for the first consolidation, but we do not enter on the first consolidation. Again, we want to make sure that we're not getting faked out, okay? So we want to enter on the second stage distribution or the second consolidation, which is this one that we have right here, okay? It's very important that you do not rush to get into your position and start looking for entries in the first one. That is way more risky than getting an entry in the second stage distribution. Again, this is a very well-known pattern. We sweep an objective, displacement, consolidation, displacement, consolidation, displacement, right? And so when we get a second consolidation, we can expect a second displacement leg, and it is higher probability that it's going to do so because it's already done it once, okay? A lot of people will get very greedy and want to enter all the way up here, but in reality, a trade from this consolidation to your sell side or buy side objective is more than enough for your daily P&L. Now that we have established the market maker sell model and the drawn liquidity, we have to talk about the actual turtle soup. So again, what is an actual turtle soup? A turtle soup is a fancier word for a liquidity sweep, okay? So you're essentially buying lows and selling highs when you are trading a turtle soup model. Now, there are 1,000 highs and there are 1,000 lows, so we have to be very careful with what highs are we selling and what lows are we buying. There's only a few specific highs and lows that I will buy or sell. And when we're talking about a market maker model, the one I am the most interested in is the highs and lows created within imbalances. So let's say that this displacement leg right here created a fair value gap. This blue rectangle represents a fair value gap that we created in this displacement leg right here. So notice how the market ran up and created a high within that imbalance. Now, the interesting thing about this high is that it did not fill the entire imbalance, okay? Imbalances are inefficiencies in the market. The market wants to fill in the inefficiency, okay? If an inefficiency is filled in, there's no reason for price to come back to that inefficiency. But if it is not filled in, well, then price still has a reason to return to that inefficiency. We made a high inside of the imbalance. I am going to expect that once a new high get put in, that high only gets put in to fill in more of the inefficiency which the first high failed to fill in. I have a few rules for this, and that basically is if the first high has not hit the constitutional encroachment of the imbalance, which is the middle point, well then the only rule that I have is that my stop loss has to be above the constitutional encroachment. Now, if the high that I am turtle souping have hit the constitutional encroachment of the imbalance, my stop loss has to include the entire imbalance, okay? So in a scenario like this, when it looks like this, and the first high did not hit the constitutional encroachment, I will again place my short position a little tiny bit above the high. And the only rule that I have, because we did not hit constitutional encroachment, is that my stop loss is above the constitutional encroachment. It doesn't have to include the entire imbalance, but it has to be above the constitutional encroachment. So it would look something like this. And obviously this would have given me a 8.57 R trade. That is not something I would normally do. So even though this is a rule, that is generally just a rule of thumb, I would have probably placed my stop loss somewhere close to this high up here. Again, that is going to be the safest entry. The absolute best stop loss, you can get is at the previous consolidation, because again, if it is indeed a market maker sell model and we are trading the sell side curve of that, well then the consolidation highs should ideally stay open. So the best stop loss that I can have is at previous consolidation highs, or again, if you're trading the buy side curve at previous consolidation lows. So this right here would have been the absolute picture perfect turtle soup trade. Again, I established a drawn liquidity. I waited for the first consolidation. I waited for a high to get put in inside of an imbalance. Then I sold the new high that we put in, and I was anticipating that to be a turtle soup of the prior high or the first high that we made within that imbalance. And that right there is essentially my turtle soup model. That is an A+ setup. The most important part of this is that you understand where price is going next. So this is a really clean example. It's not going to look like this on an actual chart. I'll show you an example, and then you'll realize that yes, it does look a lot more messy when you are trading it with actual price action. But this right here is just to give you a general idea of what I look for when I'm talking about a turtle soup model. Now, the turtle soup strategy requires a lot of experience, okay? It's very hard because of the fact that there are so many highs and lows getting put in the market every single day. When you have a turtle soup system, it is very, very important that you understand how to pick apart the highs and the lows so that you do not end up buying every single low and every single high, because again, there are very, very few highs and lows that will act as a turtle soup. So the reason why it takes a lot of experience is because you have to be able to tell the difference between a turtle soup high and a turtle soup low, and just a regular high and a regular low. A lot of people simply do not believe in the turtle soup approach because they keep failing with it, right? But that is only because they do not understand what highs and what lows are meant to be turtle souped, okay? Now, if you have a trading system, the reason why people are able to stay profitable with that trading system is because they have so strict rules for that very system so that it does not appear very often. Now, when you're talking about a turtle soup strategy, that model will appear hundreds of times throughout a day, and that is why it's such a hard model to stay profitable with. But again, that right there is a picture perfect example of the turtle soup strategy that I use on a daily basis. Now, I do use this on a higher time frame, and I also use it on an intraday time frame. So for my swing trading accounts, I also use the turtle soup strategy. For my intraday trading accounts, I also use the turtle soup strategy. Now, again, that's not the only strategy that I have, because you'll have markets where the turtle soup strategy works better. Then you'll have markets where my continuation model works better, okay? So I have different strategies for different market conditions. Now, a turtle soup strategy like this works very, very well in consolidating markets. Now, when I say consolidating markets, I mean higher time frame consolidating markets, and then trading this on an intraday time frame, because again, you are looking for these types of movements. And while this may not look like a consolidating market on an intraday time frame, when it goes up and down like this, it is probably in a consolidation on an hourly time frame. That is why a turtle soup strategy, in my opinion, is preferred on higher time frame consolidation, while my continuation strategy is preferred when we have a very, very one-sided or very, very trending market. So right here, we have a pretty good example of my turtle soup strategy playing out. So as you can see, we are very, very high up into premium. If we zoom out here, again, it's all about context, right? If we zoom out here and we draw the optimal trade entry, you can see that we are inside of a higher time frame optimal trade entry, and we have filled out the majority of this large inefficiency that we have created here. So again, I am going to anticipate, based off of recent price action, that this low is going to get hit, because again, we filled in most of the inefficiency on a higher time frame. We are delivering off of a higher time frame imbalance and higher time frame optimal trade entry. So a low like this is what we call a low hanging fruit. There are a lot of stop losses placed under these lows because they are so obvious. So all the people who longed here, and who are still long in here, very likely placed their stop at this very low. It's a low that stands out. It's a low that's alone, meaning there's no other lows around it. It's very, very obvious. And so there's likely built a lot of liquidity up around that low. We've just had a correction move to the upside right here. And as you can see, we had hit a high right here. Now let's pay attention to whether we got follow through after hitting this high. Let's zoom into a 2-minute time frame here. Now, did we see any significant follow through after sweeping this high right here? Not really, right? We got a little bit of a displacement candle here, but again, not enough for me to determine that we are in bullish order flow, okay? We did, however, get displacement to the downside, and what happened after that was we got a decent consolidation right here, right? So we have the first stage distribution, because now we have established that we swept the high. We didn't see a lot of follow through, but we did start to see follow through to the downside. We then wait for the consolidation, okay? Because we do not know whether this is indeed a market maker model to go lower yet. But if we wait for the consolidation, then wait for another displacement leg, which we got right here, and then we enter on the second consolidation, we are pretty confident that yes, this is indeed a market maker model. So again, let me run over it. We have established a draw on liquidity, which is this low that we have down here. Based off of the higher time frame, what are we delivering off of? What does previous price action look like? We have established a draw on liquidity lower. We have established a high. Did we see any follow through to the upside after sweeping the high? Not really. We got a little bit, but not enough to make us think that yes, this is indeed very, very bullish. After that, we started to see displacement to the downside. We then saw quite a decent consolidation right here, followed by another displacement leg. So now we are starting to be very confident about the order flow, because this looks like a market maker model that is going to take us down to our drawn liquidity right here. Then we take a look at the displacement leg away from the first consolidation, and we pay attention to whether we made a high within that inefficiency. And as you can see, we did actually put in a high within that inefficiency right here. So all there's left for us to do now is to sell that high. And again, remember, this high did not hit equilibrium or contested encroachment of this imbalance. So the only rule that I have is that my stop loss includes the contested encroachment of the inefficiency. So this is exactly what the trade is going to look like. We are going to target our drawn liquidity down here, and it's going to be a 5.2 RR position. Now let's actually play this out and see if we end up getting filled. And as you can see, this ended up playing out very, very, very well. And again, we followed our stop loss rule because the high that we were turtle souping, which was this very small high here, did not hit contested encroachment. And so the only rule for my stop loss is, again, it has to include the contested encroachment. And again, I don't want to see any stop losses like this. Oh, but it does include it. No, because you want to give price a chance to hit contested encroachment and give a reaction off of it. So something like that is what I would go for. And again, let's say that this wick right here that we were turtle souping looked exactly like this, and we were turtle souping all the way up here. Well, then my stop loss would have to include the entire imbalance, and I'll probably look to place my stop somewhere near these highs right here, because again, the safest spot you can place your stop loss in a market maker sell or buy model is at the previous consolidation high or lows. Okay, so that right there is indeed my turtle soup strategy. It is the easiest way to actually figure out what highs and what lows are we supposed to be selling and buying, because again, there are so many highs and so many lows that are getting created every single day. So it's very important that you understand which ones you can sell and which ones you can buy. Now, again, that right there was my simplified version of a turtle soup strategy. It is quite a complex and hard to understand or grasp strategy. Again, we're not trading support and resistance here. It is one of the more complex strategies. So again, I can't simplify it a lot more than I did here, but I really hope that you guys understood exactly what I meant. So thank you so much for watching this video. Let me know if you have any questions. Try it out and let me know exactly how it goes. And again, thank you a lot for watching, and I'll see you in my next video.